month of August has been treating you well. So just to kind of recap some of the topics we've been covering in our past episodes of Forex Friday, and of course I can see the chat window here. So if you do have any questions, feel free to ask. And what we've been talking about the last few weeks has been focused on mainly contrast, putting together a good watch list, because I truly believe that your trading is only as good as the symbols, in this case the pairs, that you are trading. So after that, by the way, so if your trading is only good as the symbols that you're trading, I would also say after that, a close second would be your trading is only as good as the time frames of those symbols that you are trading. So we've talked a lot about contrast, looking at contrast across the scope of a month, a year, building those watch lists where you have your strength currency that you're buying versus your weakness currency that you're selling, and really honing that in. So that's always going to be a constant. So one of the topics we haven't covered, and this isn't limited to just my Forex trading, although it certainly applies, but that is the sort of mindset and the methodology of entries. And we're going to start kind of broad, but it's a different set of terminology. So let's get the techno babble out of the way. And it's also a different mindset than a lot of, I would say, dare I even say, most traders out there. So this is what we're going to talk about in this episode. And like I said, I'll keep an eye on the chat window. So let's get to it. What we're going to talk about today is entries. There's the mindset, sort of the bigger picture philosophy behind entries. And if you're a stock trader, if you're a Forex trader, of course, if you're a futures trader, if you're an options trader, this is going to apply. So when it comes to entries, the first rule is I do not believe there is one magical unicorn of a level at which you enter at. I believe there's a zone, okay? Not a single level, but a zone. So that means that I have usually minimum 2 levels that I can focus on, and sometimes up to 4. 4 is a little bit more rare, but definitely I will have 3. So 2 levels. If I have a 2 level or a 2 zone entry, I'll just have kind of a high-low separation. And we'll talk about what high-low is in reference to risk in just a bit. Hey there, Deborah. Hey there, Mark. Good to see you all. Fantastic. All right, so there's the 2 zone approach, high-low, and then there is the 3 level approach. And this is where a little technobabble comes in. The first level that I have an opportunity to buy or sell at is what's known as the aggro level. Aggro is, yes, short for aggressive, but more than that, I want you to have an image in your mind. This is the image that I keep in my mind. So I'm dating myself a bit here, but there was a show that was really popular, and it was called The Crocodile Hunter. Many of you probably remember that show, The Crocodile Hunter. And there was this enormous crocodile that they had at the Australian Zoo that Steve Irwin, if you remember, the star of the show, the host of the show, he called it aggro. This giant old, I think if I recall, the alligator was a little cantankerous, but it was this giant crocodile, not alligator, giant crocodile named aggro. So yes, aggro can be sort of a nickname for aggressive, but I want you to think about that crocodile. Aggro levels are the most risky levels at which I'll enter. Aggro levels. So there's a little Ragheeism there. Aggro. Think the crocodile. Second level below that is moderate. All right, now we're just using normal words. Moderate. Moderate is what? Moderate is in reference to risk. Aggro, moderate. Crocodiles interacting with one is pretty risky. Moderate is less risk. Conservative is the least amount of risk. So I guess I could have said something like crocodiles, baby goats, and kittens. That would have been way better. And I don't know why I didn't think about that when I first started creating this. We could have had aggro levels, baby goat levels, and kitten levels, right? So aggro, moderate, and conservative. All of that is in reference to risk, but I don't call the stop loss a stop loss. I mean, I do, so people know what I'm talking about. But what stop losses really should mean in your mind is point of validity, another little Ragheeism that I coined, so that early on in my career, when I, like many other traders, were moving their stop losses around because it was usually this arbitrary percentage-based, dollar-based level. Well, if it was arbitrary in the first place, you don't think our minds know that. So if you had an arbitrary $150 stop loss, what's 160? Heck, what's 170? What's 200? If 150 was meaningless, anything that will follow is going to be equally as meaningless. You're just somehow getting closer and closer to some uncle point at which, again, subjectively, you're like, whoa, I can't lose more than $500. Again, what is that in reference to? So you want to think about a point of validity for the trade. Not what your uncle point is, not when you tap out, but what is your uncle point for the trade? So points of validity, don't even actually factor in uncle points first. Points of validity, just as the phrase explains, is when is that trade no longer valid? It's just that simple. When is that trade, not any others that you might have had preceding or might be thinking about later on, what is the level at which that trade is no longer valid? Now you might say, well, I don't know, Raghee. That's definitely some homework. So if you have a trade that went valid at a certain point, the other side of the coin is there must be a level at which it's no longer valid. Let's take a really easy example. If you have a market moving in a range back and forth, a lot of folks will short the top of the range, the resistance, and buy the bottom of the range, the floor. And probably a lot of us learned to sort of channel trading, overbought, oversold type trading early in our career. And we know to place our stop just below support and our stop just above resistance. Because we know that if the whole idea is for this market to remain in the channel, when it breaks out of the channel by some sort of wiggle, we get out. That's the validity of the trade at some point above resistance or at some point below support. So I think a lot of us have probably traded with that kind of approach in the past. All right, so with that being said, the thing to remember is every trade has that kind of point of validity, a point at which that trade idea really doesn't make sense any longer. It doesn't have anything to do with the amount in your account. It doesn't have anything to do with that uncle point, although we'll talk about where that's relevant in just a moment. And it has nothing to do with anything but, it doesn't have anything to do with secret squiggle indicators, none of that. When is the trade no longer valid? However you define that, that should be your stop loss. Now, there's another concept within this whole entry to stop loss idea that, again, isn't talked about a lot. Point of validity is, again, never talked about. That was something that a little term that I used for myself so that I wasn't arguing with a stop loss. I was now arguing with a level of validity, a point of validity. The other thing is affordability. And that word does not get used in trading at all, certainly not nearly enough. Affordability set means agro, moderate, conservative level. Which one can I afford to lose from? Not everyone can afford an agro level, hence it's the crocodile level. Some people, I would say probably most, should be able to afford the moderate. The last, the conservative, again, why is it conservative? Its proximity to the stop loss, to the point of validity, is the narrowest. Agro is the widest, moderate is the next widest, conservative is the narrowest distance to the stop loss. It's the lowest risk being defined as entry to stop. So you have to find which one of those levels is affordable. Now, what's affordable to you might be affordable to somebody else, may not be, vice versa. It's a very unique level for you and your account. It should be unique, right? It's very much dependent on what's in your account is really what I want to say. And that would mean how you position, not just whether or not you'll take the trade, but whether you take it with options, whether you take it with I'm talking all markets, right? A micro, a mini in Forex. Do you take a $5,000 nominal position size, 10,000? That's a mini. Do you go 100,000? That's a full size. Where within that can you afford to lose from? Now, affording to lose from might mean, well, Rog, I can't afford to lose with a $100,000 position, but I can afford to lose with a $50,000 position. Fantastic. Now you're getting the idea of affordability. Can I afford to lose from there? The other component of affordability is if a trade, even from the conservative level, is still unaffordable. If that distance, even at the smallest increment that you're willing to trade at, if that distance still represents too much risk, that trade, and it's okay to say, is flat out unaffordable. And, I'm going to use a completely different topic, but one probably most of you are familiar with, and that is Tesla. I took a trade in Tesla not all that long ago, and the trade in Tesla was an expensive option. I mean, it was an unbelievably expensive option compared to what I typically trade. For me, I like to trade options in the $2 to $5, maybe $700 vicinity and grab 10 to 20 of them. Tesla can be anywhere from an $8,000 to $10,000 option. For me to tell somebody to go grab 10 to 12 of those is not necessarily realistic. For some people it is, for some people it isn't. Let's take the next step. Let's say you can afford to grab $100,000 worth of Tesla. Can you afford to lose 20 to 25% of that $100,000 that you just spent on those options? The trade idea was great. I took the trade, and actually it's doing very, very well. It was a pullback into the wave, as many of you probably know that I do in the Forex markets as well. But it was unaffordable for, I would have to say, a large segment of the population. 25 years ago, it would have been unaffordable to me too, right? 32 years into my career, there are different decisions I get to make about affordability. Brand new traders wandering into the Amazons, even to some extent, well, for sure, the Teslas, those very expensive options. Some of that's just unrealistic. Doesn't mean that they're not good trade setups. They're just not going to pass the affordability criteria. And the sooner that you can just accept that some trades for right now are not for you, the better off you're going to be. Now, everybody here, I'm imagining, has been to the gym. I don't go as often as I should. But we all know, that there's certain weights that are just not in our current, right? They're just not in our current ability. If I go try to pick that weight up, I'm likely to go rip my muscle. If I go to try to squat something I'm unable to squat, I'm going to hurt myself, hurt my back, hurt someone around me, who knows? Some weights right now are unliftable. They're not in our ability. 6 months from now, a year from now, you're going to laugh at the weights you couldn't pick up and do good form and perform proper exercises with. Risk is no different. I don't know that in the beginning, even if the trade is good, you should assume more risk than you're capable of. It might be a really great exercise to do with 40-pound weights, but you may not be able to, do that exercise in proper form, and you certainly may not be able to do it with 40 pounds. You'll work your way there. So think about that when it comes to size. I don't believe size is just this arbitrary formula that I plug my account values in, pip values in to come out with some kind of position size. I don't believe that at all. I believe you earn your size. You earn your size with study. You earn your size with taking trades, building confidence. You'll be amazed how your confidence and your size tend to move with each other. They really should be on this parallel and upward route in a natural, improving trading type evolution. Okay, so think about affordability. Think about multiple layers of resistance. Multiple layers of entries, multiple layers of affordability. In other words, multiple layers of affordability means not just size, but where you're building that size from, which means it takes me to another concept within our entries called scaling. Scaling means this: your most aggressive aggro level should be the smallest position size, not the largest. Most traders build their position sizing, can you see that? Kind of makes sense? Like an inverse pyramid. The largest, and then as they get down to that conservative level, that's your smallest position. You really should be building your position size like this: smallest at aggro, larger at moderate, largest still at conservative. So think about triangles or pyramids when you're scaling in. All right. So let me grab a few questions here. All right. Rich, I'm thank you very much. You're super kind. I think that unconscious competence is something that a lot of traders are blessed to have. They're very good at it, but they're not necessarily great at teaching it. And it's definitely like any other skill when you develop. I hope I'm a better teacher of trading another 10 years from now. Not just a better trader, hopefully I'm a better trader too, but everything is a skill. And I appreciate that. I think it's really seeking out conscious competence, right? Being aware of what works. And as I become better as a trader and as I begin to study my trades, I still study my trades as if it was day one, year one of my trading. I find certain things work better or worse, and I can get more and more granular on what I see works, and then I'm able to share it a whole lot better. I hope. I hope. All right. So I hope that helps. We haven't talked about entries, I believe, before in our Forex Fridays, and this applies to my day trading options or swing trading futures or investing in stocks. It doesn't matter. I keep this type of affordability and multi-tiered entry scaling in approach in mind. So I hope that helps. I hope that's something you can put to work today, or your very next trade. Ask yourself, what's the entire zone that I could get into? What's my point of validity, not dollar-based stop loss? What are those? Have I spent the time to identify those? Spend the time to identify those. It's going to make a sea change in your trading. All right, everyone. I hope you enjoy your weekend. Thanks as always. Thanks as always for joining me for these Forex Friday little get-togethers. Great to see some familiar names. And I will see you all in the next episode. All right, gang. Be good to each other.